San Francisco's housing market has done something no one thought possible. After years of soaring prices and record-high borrowing costs, the city has returned to what economists call normal. The numbers prove it. Since July 2018, home prices here have climbed just 8%. Compare that to a 56% surge nationwide. Incomes in San Francisco? Rising 7.7% each year, nearly double the U.S. pace of 3.9%. And with mortgage rates now pegged at 6.7%, the stakes for buyers and sellers have never been higher. The path to this so-called normal didn't happen overnight. It was forged through one of the most turbulent housing cycles in California history. During the pandemic, migration patterns shifted, inventory shrank, and prices across the state went vertical. But in San Francisco, the story bent differently. Redfin's models point to July 2018 as the last time the market was truly balanced. Since then, while the national median price surged 56%, San Francisco crept up only 8%. That gap tells the story. Instead of a freefall crash or a fire sale correction, San Francisco simply plateaued. And it isn't alone. Oakland is on track to reach the same normal level this month if prices hold flat. That puts the East Bay in rare company, because outside the Bay Area, almost no U.S. metro will see balance for years. Redfin projects Austin, Texas won't get there until March 2027, Sacramento, November 2028, San Diego in early 2029, San Jose not until May 2029. One California market, though, will never go back. Anaheim. Prices there have accelerated so far beyond income growth that no 10-year projection brings the market down to pre-pandemic affordability. For buyers, that means the dream of a reset is already off the table. So when economists describe San Francisco as back to normal, it's less a celebration and more a caution. The market avoided collapse, but also avoided healing. Instead, it froze in place. For every new household arriving, the cost burden remains heavy. And across California, the timeline is clear. If you're not in San Francisco or Oakland, you'll be waiting years, even decades, for conditions to resemble anything close to balance. This is the setup for the state's new housing reality, a reality defined not by boom and bust, but by endurance. So who is driving demand in a market that feels both frozen and unaffordable? The answer isn't the typical first-time buyer. It's a new wave of high-earning professionals, mostly tied to the tech sector. Redfin's own agents report that artificial intelligence companies aren't just clustering in Silicon Valley anymore. They're setting up shop inside San Francisco itself. To compete for scarce talent, these firms are offering unusually high salaries and eye-catching signing bonuses. That cash is flowing straight into the housing market. Agents describe a profile that repeats again and again. Young tech workers in their 20s and 30s, often couples combining two six-figure incomes. For them, the sticker shock that freezes out most Californians is still manageable. Rising household incomes, growing at 7.7% annually in San Francisco compared to just 3.9% nationally, create a buffer that reshapes their buying power. And critically, these buyers see relative value where others see only pain. With national prices up 56% since 2018, but San Francisco up just 8%, the city actually looks like a bargain if you're earning well above the median. In their eyes, this isn't a distressed market, it's an opportunity. The result is a two-tier system. For longtime residents, affordability has barely budged. For the new class of KEK earners, San Francisco is one of the few global cities where wages are rising faster than housing costs. That imbalance keeps demand alive even as supply remains scarce. This is why San Francisco's normal isn't really normal at all. It's normal only for those with the means to play.
But there's one factor. Redfin's normal model doesn't count. And it may be the one that cracks the foundation. Insurance. In California, the cost of insuring a home has exploded. Premiums are climbing at double-digit rates, and some carriers are walking away from entire zip codes. That means even buyers who can manage the mortgage payment-to-income ratio are blindsided by rising monthly obligations that never appeared in the affordability math. The state's insurer of last resort, the FAIR Plan, has nearly doubled its policy count in recent years. Families who once paid standard premiums now face steep surcharges under emergency coverage. In wildfire-prone corridors, and even in parts of the Bay Area, this shift can add thousands of dollars to annual ownership costs. And yet, Redfin's formula that declared San Francisco back to normal excludes these expenses. The headline may suggest stability, but the underlying reality is that ownership costs are accelerating faster than the models admit. Consider this. A household earning above the median may secure financing at today's 6.7% mortgage rate. On paper, their debt-to-income looks sustainable, but when property taxes and insurance premiums are stacked on top, the balance flips. A home that seemed affordable in theory becomes a financial strain in practice. Economists warn that this gap could distort market behavior. Sellers believe prices are stable. Buyers see affordability restored. But insurers keep shifting the ground under their feet. Deals that looked certain at contract signing collapse when the final insurance quote arrived. This is the overlooked shock in California real estate. Not falling prices, not collapsing demand, but the creeping, relentless rise of insurance. The one bill that doesn't care about normal. If normal only looks at mortgage payments versus income, it misses the real math of owning a California home. Affordability is more than principal and interest, it's every cost that stacks on top. Start with the baseline. Redfin calculates San Francisco's mortgage payment-to-income ratio as roughly equivalent to July 2018. On paper, that suggests balance, but the ground has shifted. In 2018, buyers could still lock in rates near 4%. Today, the going rate is 6.7%. That difference alone adds hundreds of dollars per month to a typical loan. Then layer in property taxes. For a $1 million home, which remains close to San Francisco's median, taxes run tens of thousands of dollars annually. Redfin's normal model excludes those costs. The same is true for homeowners association dues in the city's dense condo stock. Many buyers face HOA fees of $500 to $1,000 per month. Assessments for building repairs can be even higher. And finally, the wild card: insurance. As premiums climb across California, especially in fire risk zones, annual bills can spike by thousands. One economist noted that these uncounted costs alone could flip a normal affordability calculation into a warning sign. So, while household incomes in San Francisco have grown 7.7% annually compared to just 3.9% nationally, that extra income doesn't stretch far once the full cost stack is applied. Mortgage plus tax plus HOA plus insurance equals a monthly outlay far above what the models suggest. This is the paradox. San Francisco can be back to normal in a narrow, technical sense, while still feeling impossible for average households. For young tech earners with bonuses and stock options, the numbers pencil out. For everyone else, the math remains unforgiving. Even when the numbers look balanced, the market itself tells a different story. Liquidity, the ability to buy and sell homes smoothly, has been throttled. In San Francisco, inventory remains historically tight. Sellers who locked in 3% mortgages before the pandemic hesitate to list, knowing replacement homes would cost far more at today's 6.7% rates. That creates a standoff. Fewer listings on the market, fewer buyers willing to stretch. The result is sluggish turnover. Deals take longer to close. Days on market creep upward compared to the boom years, and buyers who enter contracts often back out. Redfin agents describe cancellations spiking when insurance quotes or HOA assessments finally land on the table. What looked affordable in a spreadsheet collapses under the weight of real bills. This liquidity freeze is not just a Bay Area phenomenon. Across California's high-cost metros, the same pattern repeats. Sellers can't afford to move, buyers can't afford to commit. Sacramento is projected to hit normal in 2028, San Diego in 2029, San Jose the same year. But the path to those benchmarks runs through years of low sales volume and constant gridlock. Contrast that with Anaheim. There, the problem isn't just timing, it's permanence. Redfin projects the metro will never return to normal. Prices rose so fast that liquidity is less a question of when and more of if. Without a drastic shift, deals will remain scarce indefinitely. San Francisco may wear the label of stability, but its market still feels like molasses. Buyers hesitate, sellers hold back, and every month fewer homes actually change hands. Liquidity has become the hidden casualty of California's real estate reset. California's housing market doesn't only move with interest rates and incomes. It can seize up overnight, triggered by shocks no model fully captures. One of the most powerful is climate risk. Wildfire maps are redrawn, flood zones are reclassified, and suddenly entire neighborhoods face higher insurance costs or no coverage at all. In those moments, transactions freeze instantly. Buyers walk away, lenders pause approvals, and sellers are left holding contracts that can't close.
Insurance carriers themselves have become another trigger. When major providers announce they're pulling out of California markets, the effect is immediate. Buyers who thought they had coverage scramble to find alternatives, often landing in the state's FAIR plan, the insurer of last resort. Premiums double, monthly costs spike, and deals collapse. Policy shifts add a third layer. Legislative moves to tighten building codes or adjust zoning can stall projects midstream. A county-level directive can create delays for weeks, even when the broader state market looks stable. This is why economists warn against treating normal as a steady state. San Francisco may show balance on a chart, but all it takes is one advisory, a wildfire warning, a flood map update, or another insurer exit to paralyze activity for months. In California real estate, the market doesn't just cycle. It jolts, freezes, and restarts, sometimes in a matter of hours. Behind every housing number is a fight over who sets the rules. In California, that fight is constant. State regulators, city governments, counties, and lenders all pulling in different directions. At the state level, Sacramento defines affordability standards and sets the framework for insurance oversight. It's the state that approves FAIR plan expansions, and it's the state that measures when a market like San Francisco is considered back to normal. But on the ground, counties and cities often push back. Local zoning laws, building restrictions, and rent control measures can either tighten or loosen market pressure. Lenders add yet another layer. Their underwriting models must adapt to wildfire maps, flood zone reclassifications, and new insurance realities. A loan approved in principle may collapse once local requirements are factored in. In some cases, regulators push for affordability credits, while banks move in the opposite direction, demanding higher reserves. The result is friction. A state economist may declare hopeful signs for buyers, yet a city planning office can stall projects or a lender can tighten terms. Buyers and sellers are caught in the middle, watching rules shift from one jurisdiction to the next. San Francisco shows the clash most clearly. It's the state's poster child for normal, but locally, it's still described as unattainable. Policies meant to stabilize the market often collide with realities that keep housing out of reach. California's real estate story is not just about numbers on a chart. It's about turf. Who controls the levers, and whose rules decide whether a deal survives or dies. California is not one housing market. It's a ladder of local realities, some climbing back toward balance, others slipping further away. At the top is San Francisco. By Redfin's formula, the city has already returned to normal, its first time since July 2018. Oakland, just across the bay, is expected to follow within weeks, provided prices stay flat. These two metros stand alone, unique in the nation. Next down the ladder is Austin, Texas, the first non-California market projected to normalize, but not until March 2027. Then Sacramento in November 2028, San Diego in early 2029, San Jose by May 2029. The message is clear. Even within California, balance is still years away for most regions. And at the bottom, Anaheim. Unlike every other metro modeled, Anaheim is forecasted to never return to normal. Prices there rose so far beyond incomes that no projection brings affordability back within reach. Even a decade out, the numbers don't line up.
This creates a tiered California. San Francisco and Oakland are outliers, where income growth nearly matches housing costs. Sacramento and San Diego are still years away, dragging under the weight of slower income gains and high baseline prices. Anaheim has effectively broken the model, a case study in permanent disequilibrium. For buyers, these city-by-city timelines aren't just academic, they set expectations. In San Francisco, the question is whether normal is livable. In Sacramento or San Diego, it's how long you can wait. And in Anaheim, it's whether you accept that affordability may never return. California housing isn't one story. It's 6 different ones, each moving at its own speed, and each reminding us that normal depends entirely on where you stand. So what does all of this mean right now? For buyers, it means that normal is a moving target. In San Francisco, the math may look balanced, but affordability is still out of reach for most households. Oakland is next in line, but the rest of California waits years. Sacramento in 2028, San Diego and San Jose in 2029. Anaheim, by every projection, never resets. For investors, the checklist is blunt. Factor in insurance, brace for property taxes, and expect higher HOA assessments. Those costs are climbing faster than incomes, and none of them are captured in the optimistic back-to-normal models. The 6 to 12-month outlook is cautious. Inventory will stay tight, liquidity will remain thin, and sudden shocks, whether from insurers, wildfires, or local policy, can freeze deals overnight. The recap numbers tell the story. Home prices up 8% in San Francisco since 2018, compared to 56% nationwide. Household incomes rising 7.7% per year in the city, nearly double the U.S. pace. Mortgage rates at 6.7%. Anaheim, never normal again. This is California's new housing reality, a state where normal doesn't mean affordable and never will.